Airline stocks have rallied of late, and JP Morgan says those gains are unlikely to last. This chart shows the Amex Airline Index, which includes Continental, Delta, and Jetstar, outperforming the S&P 500 over the past 6 weeks. But JP Morgan says that won't continue. It expects airline revenue to tumble this year and has already downgraded Continental and U.S. Airways. Something to think about for investors who have money in Chinese airline stocks like China Southern and China Eastern. They've also rallied during the past month, outperforming the Hang Seng Index in Hong Kong. And talking about airlines, Qantas Airways forecast a record second-half loss earlier this month. It will also cut 1,750 jobs as demand for business and first-class travel falls. As the recession hits travel spending, Qantas is looking to Jetstar Airways, its budget airline and fastest-growing unit, to drive growth. Here's the man behind Jetstar. Bruce Buchanan is Jetstar CEO. He joins us from Melbourne. Bruce, good day, mate.
Hello, thank you for having me today.
Hey, is Jetstar seeing more corporate travel as people trade down from Qantas?
Well, look, I think the trends of trading down are over-exaggerated. I think what we're actually seeing is the market at the lower end of the market is holding up reasonably well. And, with a drop in fuel price, we've seen effectively, almost a two-third drop in fuel price, which is our biggest cost driver. And that's really having quite a significant impact on our ability to drive the right economics in our business. Because even when you get yield degradation, when you've got such a big cost advantage by fuel dropping to that extent, it gives you the room to really grow quite profitably. And that's what you're seeing in Jetstar. We're continuing to grow and chase opportunities in the marketplace.
But what kind of numbers are you looking at?
Well, look, we're still growing aggressively. We've got next Tuesday, we launch our Auckland services. We've committed also to some more aircraft in Singapore now, and we're going to grow our services out of Singapore, and we're looking to really beef up our capacity and presence in the Singapore market after the shareholding realignment that we announced a few weeks ago.
Bruce, can you quantify the numbers?
No, I can't give you exact numbers. What I can reiterate is to say that, as Alan Joyce said when he announced the profit downgrade for the Qantas Group, that Jetstar is tracking well and on target. We continue to see strong demand, as you see in our monthly statistics that we report to the ASX. We're continuing to track quite well, and we think that the leisure end of the market, from what we can see, is actually holding up quite well. There's all sorts of forecasts out there, and I think the market generally is very volatile, and you're probably seeing that across a whole lot of industries at the moment. But, we're seeing what's coming through the windscreen at the moment. We're seeing very strong demand. We're seeing strong revenue figures, and we're seeing pretty strong growth numbers. Singapore and New Zealand very much on our radar screen at the moment. Additional capacity we've announced up in Japan as well. Darwin Hub, Perth International. Lots of capacity coming into the market for us, and we're continuing to grow aggressively.
So having said that, do you see Jetstar taking more routes from Qantas? What routes would make sense for you?
Look, I think the two-brand strategy has always been central to the Qantas Group positioning. It's all about what the market demands, and the market moves quite suddenly, and what we're seeing is obviously a drop in corporate travel. We've seen leisure demand holding up there. We're continuing to grow Jetstar quite aggressively because demand's there. But at the end of the day, the customer will decide, and I think what's quite unusual is if you look back in the history of the Qantas Group, actually Qantas has grown quite substantially as well since Jetstar was started. The two-brand strategy is about growing both brands, but growing them as market demand warrants. So I think, it's not so much about taking over routes, it's about what the customer demand dictates, given we've got two products that sit at different ends of the market.
Your competitive advantage is lower cost. How much lower can you keep expenses? How else will you cut costs?
Well, I think the trick is in the airline model is about continuing to drive efficiencies. And I know there's this great story from Southwest. I think during their first 25 years they drove down their unit cost every year. And that's a real telling story about what's important in the low-cost space, which is to find efficiencies and continue to find efficiencies. And whether that be technology or distribution or different ways, the internet's been a great tool for us to take advantage of. There continues to be great opportunities for us to take advantage of and get cost advantages as well as getting revenue advantages. And that's what the business is all about. And in this time, it's no different than any time in the past. We're going to continue to look to drive efficiencies in our business, look to deploy better aircraft, newer aircraft, better technology, look to get our bases more efficient, look to get our our operating model and our communications with customers more efficient. And it's just it's part of the model. It's what we're all about. It's part of our DNA is, relentlessly driving efficiency in everything we do.
Bruce Buchanan, CEO of Jetstar, good luck and thank you.